Hello, and we want to welcome you to another presentation in our teleseminar series hosted by Pettis Rumsey CPAs. Tonight's call is titled, How Does the Supreme Court Ruling on Obamacare Affect You? And we're on the line with David Rumsey CPA and President of Pettis Rumsey, Inc., a Marysville CPA firm that provides a wide variety of accounting, tax, and financial management services tailored to meet the needs of business clients and individuals. If you don't know David, he's, like I said, mentioned a CPA and an investment advisor representative in Snohomish County and Marysville, and he has also written several articles in the past for the Snohomish County Business Journal. And again, tonight, David is going to be talking about how does the Supreme Court ruling on Obamacare affect you? David, good evening, and welcome to the call.
Good evening, everybody. Thank you, Jeff. I want to welcome everybody to this call tonight. At the end, we are going to open up for some questions. I was really fortunate to receive some great questions during the registration process, so I'm going to do my best to touch on all those either directly through answering the question at the end, or you may pick up or find your answer as I talk during the program. First of all, want to make clear a couple of things about this act. It's called Obamacare by many people, so that's kind of the term you hear in the media on the internet, but the actual name is the Affordable Care Act. It was signed into law March 23rd, 2010. The reason we thought it might be an interesting topic is that just in the last few weeks, the Supreme Court went ahead and allowed this act to still be in play. There were a lot of people who felt that once it went to the Supreme Court, the individual mandate that we'll talk about that comes into effect during 2014 could be ruled as unconstitutional. The Supreme Court decided that the individual mandate is basically an opportunity to tax and that the government is allowed to tax its citizens. So the plan or the act is known as the Affordable Care Act is still alive and kicking. And it has actually been doing some things kind of behind the scenes as far as the last 2 years that we've seen since it's been in place. Again, it started March 23rd, 2010. It is nearly 1,000 pages in very small print. There's 92 provisions in it. These are sweeping changes, both in the tax area, the way health insurance companies do business, the way you and I will be being able to shop for health insurance, whether we're self-employed or individuals. So it is a very big deal that will be coming down the pike. My goal tonight is to try to touch base on some of these provisions that are out there and to hopefully show how it may be affecting you, maybe family, maybe friends, your employees, coworkers. It's going to have some impact in an area of your life, just about guaranteed. The question will be how much will depend on your situation or your family's situation and the stage you're at in your life and things of that nature. So one of the first things I think it's always is what was the basis behind this act? Very controversial act, but there were three basic problems that were looked at. Number one, the cost increase of health insurance has been screamingly growing over the last decade or even 20 years. So that's a huge part of it. People are not able to keep up, and more people were basically uninsured. A lot of people were more and more finding that they were being kicked out of the insurance companies. In other words, if they had a pre-existing condition, they weren't able to get the insurance. So insurance companies got tighter and tighter about being able to not allow you to be covered. No coverage, no insurance. This, of course, leads to full ER rooms. It leads to many bankruptcies, huge cost. In fact, studies show that currently 1 in 7 are uninsured. So 1 out of every 7 Americans have no insurance. So those are the three big reasons why, or problems that led to this act. That was one of the goals of trying to do it. Whether or not they'll be successful fixing these is still to be determined. And a lot of this, I think, while we do know a fair amount of how things are going to work, there will be changes. I'm almost certain I can feel confident stating that opinion. So this will be flexible, but at this point, I would say that we're getting close to the 2 years that really start making an impact, and I think the sooner someone prepares, the better to know how it may or may not affect them. So the next topic or section, I'm going to talk about some key provisions. So as I mentioned earlier, there's 92 provisions. I'm not going to put you to sleep by talking about all 92 of them. I'm happy to answer any questions that impact you. You're always welcome to email me, but if there's anything that impacts you individually or personally, I'm happy to try to get you the answer as best I can. So I'm going to try to target some things based on each year since the Act has been enacted, and then all the way into the future with how this plan comes about. In 2010, that was the year the Act was signed by the President, and it included small business tax credits. So those companies out there that are small in the sense of number of employees, there would be some benefits that you could actually get some tax credit based on paying the premiums of your employees. So that has been in effect since 2010. So I've done a 2010 and 2011 tax returns, and there are some of my clients that have benefited from this tax credit. Many, though, have not because of the way the formula is set up. So here's something that's a little frustrating that I see that people will say, hey, there's a lot of companies out there that can benefit from this tax credit, but then when we do the calculation, their average wage is too high, so there is no tax credit, or it's very small. So I take this one with a grain of salt, but this was one of the first things that the government did to hopefully encourage employers to continue offering coverage or adding coverage to their employees. They also introduced in 2010, and this has been a positive for a lot of families, that if you're under the age of 26, you can still stay on your parents' plan if you don't have coverage through your employer. And this is a big one, particularly with the high unemployment. There's a lot of kids that are graduating from college that are still unable to find employment, or any employment they do find, there's no health insurance, so they can stay on their parents' plan up until the age of 26 as opposed to being kicked off a lot sooner before. So that's giving some kids some relief and being able to still get some care and not have to go bankrupt or whatever because they don't have insurance. 2011 introduced some free preventive care options for seniors, things such as wellness exams. It also, one of the things that a lot of people aren't aware of in 2011, it started the process of forcing insurance companies to be a little bit more responsible or efficient in the way they spend the premiums that they earn from their customers. For example, there were companies that would spend 30% of all health care premiums on overhead. Now it needs to be 15 to 20%. So it's like this scenario with charities. You hear a lot of people say, well, I don't want to deduct or donate to this charity because their overhead is so high. Not enough money is going to where I want it to go, the programs or the people in need. Same thing that happens here, CEO salaries, marketing, all those things now have to be spent wisely. Otherwise, there's money that has to be rebated back to the premium payers if the insurance company's not doing. So a little hidden area in there to try to encourage insurance companies to be a little bit more efficient in the way they do things, therefore not having to pay money back to the policyholders. 2012, the biggest thing that comes up here is W-2 reporting of premiums paid. So if you are an employer and you pay your health insurance premiums for an employee, you are required to put that on the W-2, and this will be something going on forward. I step back here to mention there's a lot of myths out there on this plan, some good, some bad, one of the plans one of the myths I was told about this plan by clients reading things on the internet was we're putting the premiums that the employer pays on your behalf on the W-2. Therefore, they think, hey, we got to pay taxes on that when we do your 1040. That is not true. What they're trying to do is get to be able to understand which employers are covering their employees and which are not. That comes up in 2014, which we'll address in a minute, to talk about the requirement for employers, some employers anyhow, to provide coverage. So if you get a W-2 in January of 2013, which will be for the 2012 year, you will not be including the health insurance as additional income on your tax return. If someone does do that, they are doing the return wrong. So it is for informational purposes, just like union dues, labor and industry deductions, 401k, retirement. There's a lot of things on a lot of people's W-2s that are informational, and this is just going to be one more that's added to it. So that's where we're at current and past, 2010, 2011, 2012. So you say at this point, wow, not really a lot has changed. And I agree. As a business owner, I have not had to do really anything major new. But 2013, we're only about 6 months away, and that's when things really start coming into play. For instance, in 2013, there'll be a $2,500 limit for flexible spending accounts. So that'll be the most you can put in there. So there's a change there for those that have that. There'll also be higher Medicare taxes for individuals that have income of $200,000 if they're single, or $250,000 adjusted gross income if they're married filing joint. So here's a tax increase. There's a 3.8% tax on investment income. So I'm going to touch base about taxes in a separate section here of the talk, but these are things that are happening and coming into effect in 2013. So obviously this is a big issue, and it will be talked about all summer and into the fall with the presidential campaign that we're looking at. But these provisions will affect quite a few people. It will not affect everyone, so this is important to understand. This is based on your income, your adjusted gross income, for those that will see this additional tax. So you hear a lot of people out there say, oh my gosh, my Medicare taxes are going to go up. They're going to be taking out of my paycheck. That's not accurate for most Americans. Most Americans do not have adjusted gross income of $200,000 or $250,000 if they're married. There are those that do, and this will be a planning item that you have to make sure you're aware of. My understanding of it, it'll be reflected in your payroll tables and your deductions, but if you're self-employed, it'll be something that you'll have to plan for accordingly as you plan for your taxes overall during the year and going forward. So those are some big ones that come into play in 2013. 2014 is also a big year. In fact, 2013 and 14 to me are the two big years. 2014, things will pop up that we haven't seen before. Number one, health insurance exchanges. What this is that there will be an exchange set up in each state. These exchanges are designed to make buying health care coverage easier and more affordable. They will allow individuals and small businesses to compare plans, get answers to questions, and work out to see if they're eligible for any tax credits or things like that. So what's happening is in 2014, you're required to have insurance. That's the individual mandate. So I myself have found there's not a lot of options for small businesses in choosing health care plans for their employees, and the owner myself as it is. The idea with this is these exchanges will allow more competition. There'll be more health insurance companies that will be in these plans that will be administered through the states. So this exchange is set up for both individuals and families. It's a single place where you can enroll for private or public health insurance coverage. It's also for small business a way to level the playing field that allows you to have better choice of plans and insures at a lower cost. Basically, as I said, small companies, not a lot of options. Larger companies, they have much more of a base that the insurance company can spread its risk over, so therefore their premiums tend to be anywhere from 10 to 20% less than what it is for a small business to have this. So this is key. Now, Washington, I'm in Washington State, it will have an exchange, and therefore we will be learning probably, I would say, mid-2013 about this exchange as they get it up and going. But this is where you're going to go as an option to buy your health insurance, whether you're an individual, families, or a small employer. So this is definitely a new thing. In 2014, there is the individual mandate, and what that means is every individual is supposed to get some form of health insurance. Millions of Americans right now are not covered, and the idea is that they will be able to go and get coverage. Employers, there will also be this rule for employers to go out and provide health insurance for their employees. Key thing here, it's very important, this is another myth that's out there, is all employers are going to have to provide health insurance to their employees. Number one, if the employer has less than 50 full-time employees, there is no requirement. So this is for companies that are fairly decent size. Most businesses that are being started today or that are out there have less than 50 employees. Most of the larger companies, the Fortune 500, many of them already are offering coverage, so nothing's going to change for them. But there will be a segment of businesses out there that will have to provide some sort of health insurance or expect to be hit with some additional fines or taxes if they do not. We go back to that health insurance exchange, and these things are supposed to be there for these type of employers to be able to buy the insurance, hopefully at a lower price than they would currently. I say hopefully because I am somewhat leery to know how competitive this is going to be. This may depend on how competitive it is in your state. It's going to be very interesting to see how we compare those premiums to what they could buy currently versus what they'll be able to do through the health insurance exchanges. 2014, also pre-existing conditions. This is a big area where a lot of people, as I said earlier, have been denied coverage based on health issues they have. That will go away in 2014, and an insurance company cannot deny you based on a pre-existing condition. There will also be the opportunity for more lower-income individuals and families to be able to apply for Medicaid. Typically, Medicaid prior to this is, for the most part, for seniors. That's going to go away as well to where it'll open up for younger individuals. So you can see 2013, 2014 has a lot more teeth in it. 2018 is kind of the next big thing for the very few out there that have these very high-cost insurance plans. Typically, they're wealthy individuals or they do very well working for large companies, so they have this wonderful healthcare coverage. They will be subject to an additional tax on the amount of the coverage. That comes in effect 2018 as we stand, so that's not anything on the horizon that we have to worry about in the short term anyhow. 2013, 2014, though, are on the horizon, so I'm going to focus next on the taxes. Being a CPA, most of the questions I get have to do with taxes, so I think it's important to kind of single out the tax impact on people. And there's really 5 taxes that kind of come into play here with this Affordable Care Act. And they basically come into effect here in 2013 for the most part. Number 1, I mentioned earlier, the limits on federal spending accounts. The reason I call this a tax is because they're limiting the deduction that individuals may get. They're only letting you do $25,000 pre-tax to help pay for that. That's it. Basically, a lot of people or some people were able to set aside as high as $5,000 to help save on their taxes. So if you take away someone's deduction, you're in a sense raising their taxes. So it doesn't matter what the deduction is. It could be mortgage insurance, property taxes, health insurance, a business deduction. If you take away their deductions, you're in a sense raising their taxes. So by limiting the FSA contribution amounts, you're in a sense raising the taxes. So that's number one. Number two, this is kind of an area that I haven't heard a lot of talk about, and this will have some impact on some individuals. But under current IRS rules, American taxpayers are allowed to deduct medical expenses on Schedule A if they exceed 7.5% of their adjusted gross income. Now, I will tell you that many clients have come in here and we've added up their medical expenses, and they do not currently add up to exceed the 7.5% of their adjusted gross income. So, but there are some that do. The key here is that 7.5% is going to increase to 10% starting for tax years in January of 2013. So this means you'll have to have 2.5 additional expenses just to qualify for the deduction. So the key is here, you're somewhat taking increasing the income limitation, that increases the taxes. So in other words, if your adjusted gross income is $50,000, currently you take 7.5% of that, which works out to be $3,750. Anything over that amount, if you currently are filing Schedule A, you can deduct that amount that exceeds $3,750, which again is the 7.5% on $50,000 of income. So here we are with the 7.5%. Now they're going to increase that by 2.5% to $10,000. So if you take the 10% times 50,000, now we're looking at 5,000. Anything over 5,000 you'd be able to deduct. So it is going to have an impact on those that have high medical, that they're not going to be able to have the same amount of deductions as they would have before. I do believe there's a break for seniors for the first few years that doesn't hit the 70, doesn't increase it from 7.5 to 10, but I believe after 2016, if I'm not mistaken, that amount jumps to 10 for everybody. So that is definitely an impact. The Medicare tax, that is kind of in two sections. There's a payroll tax, which is a 0.9% payroll tax increase for business owners and employees who earn more than $200,000, and for married couples that earn more than $250,000. So here again, if you make $75,000 or you and your spouse make $120,000, you will not be hit with this Medicare payroll tax increase. If you make over the $200,000 if you're single, or over $250,000 married couples, you are looking at an increase though, and this will be ran through your payroll on any income over these amounts starting in 2013. So, for instance, if you made $201,000, you take 1,000 multiplied by 0.009, and that is the additional tax you'll pay. So here's the thing I hear many times saying, oh my gosh, they're going to increase my Medicare taxes on all my wages. No, it's only on the amount over those limits of $200 and $250. So there again, if you're over that, yes, you will see your tax increase. If you are under that, this will not impact you at all. So that's the Medicare 0.009% or 0.9% payroll tax. There's also a second tax in that area that's also going to be going towards paying Medicare. It's a 3.8% Medicare tax, will be applied on any unearned income. Unearned income, the definition of that is interest, dividends, capital gains, rents, and royalties. Here again, we have an income level that we have to be aware of. This is for anything that exceed $200,000 for individuals and small businesses, or $250,000 for married couples filing jointly. So if you have $100,000 in investment income and you're over the threshold, of income, you will pay an additional 3.8% on that 100,000. Here again, a lot of people are talking about this tax, or I read a lot of things about it. It will only apply, though, to a certain group of individuals that have this investment income. Now, one of the things that came up, and I was just asked about this today, and they said, well, what about when I sell my house? And they're right. That is considered investment income, but it's only taxable investment income. If you lived and owned your home, lived in and owned your home 2 out of the last 5 years, and you haven't sold a home in that 2-year period, then, and it's your personal residence, that amount is not taxable. Therefore, it won't add in to the $200,000 and the $250,000 income amounts. Now, if you do sell a rental property or a vacation home or an investment, those type of capital gains, selling stocks, investments, mutual funds, those will count towards your investment income and could very well, particularly in 1 year, put you over. If you had a rental property you had a long time, you were able to sell it, make a nice profit, you'd be looking at an additional 3.8% on the investment income over those thresholds. So it is something you definitely have to plan for. And remember, this is not something like mini taxes. It's a year-by-year scenario. So you may have 5 years where this would never impact you, but say you inherited some money that had some investments and then had some gains and you sold. You had a huge amount of investment income that came in. Maybe 1 year this would impact you. So if any of those things happen, you want to work with your investment tax person to make sure that you're being smart with the tax, because you could get hit with this additional 3.8% on top of what you're already paying, depending on your tax situation that you're looking at. But for most people, this will not impact them as well, because most people don't have that adjusted gross income, and they don't have the large investment income year in and year out. But those that do will have to plan for this 3.8% tax. So the house tax is kind of the fifth tax. I kind of threw it in with investment income, but the key is that we're looking at rental properties, second homes, vacation. We're not looking for your personal home, because for most people, since the Clinton administration, when they compromised on various issues, the home rules and the exclusion for gains of $250,000 of single and $500,000 for married couples, very, very few people compared to the old days are having to pay capital gains on selling their house. So I think that'll still be going for as well. The next section that I want to talk about is looking at some of the myths and some things about seniors and some things that are tied in to that regarding this act. One of the first things is that you've heard out there, or it was been read, is that this is going to wipe out Medicare and cut. Medicare is still going to be going. It's actually increasing their funding. They're trying to decrease the rate of increases that Medicare, the system, is coming out with. But as I mentioned earlier in the tax section, there is a Medicare payroll tax. There's a Medicare investment income surtax. These are items that are geared towards going to help continue Medicare and to help fund it. So there's no signs of anything that I've come across anyhow that says Medicare is going to be cut based on this act. Now, Congress and the president, future presidents, can always change any laws, just like tax laws, and odds are things will be changed or adjusted through this. But as of now, there's no signs of major Medicare funding or people getting kicked off of Medicare. One of the interesting ones during the last campaign that came up, or at least the middle term elections, was death panels, rationing care. There is an independent payment advisory board that is out there. Their job is to report to Congress about different costs and hopefully efficiencies and things of that nature. They have no power to make any decisions on people's care. This is kind of a scare tactic. Both parties use these type of things when it seems like whenever it's in their best interest, but there is no death panel or rationed care. I guess I take that back. I read somewhere that there currently are death panels out there, and they're your insurance companies, because if they tend to turn down care for people such as prescriptions or surgeries or things like that, we all know that basically that could lead towards your loved ones or family members, friends, ending their lives sooner because they weren't getting the care. So insurance companies have been rationing care for years. A lot of people don't look at it that way, but there's stories out there where people were turned down for things, and therefore it led them to not get the care they needed. So, but as part of this act, there is no item in there that I was found that said we're going to have a death panel out there. The hope is that there is a myth out there or difference of opinion. I don't even know if I want to call it a myth, that says that health care will drop. The cost of health care will drop. I think the best we can hope for at this point, until further evidence, is hopefully the rate of increases will hopefully drop. So instead of it increasing 20% a year, it could drop to 10% increase. That's been one of the biggest things, and would be a step in the right direction. It's interesting. A lot of people said if you force businesses to provide health insurance, a lot of them are going to go out of business. Well, they compare this plan, because the closest out there is the Massachusetts plan from 2006, and actually 4% more businesses in that state are offering health insurance than they did before. So it's hard to say what will happen in this case. That's a small scale compared to over 50 states, but there again, there's nothing that's seeing to do. And frankly, nothing's going to change in the sense of large companies providing health care to their employees. They're still going to do that, in the sense they're not going to stop just because of this act. It's a way of getting good talent, and it's a good benefit as long as they're able to still deduct the premiums, which currently the tax code allows them. Some significant tax breaks in that area. It's going to be a smart thing to offer employees. They can pay these premiums and not have to pay payroll taxes on them. So there are some benefits for an employer to provide coverage if they're able to, and the hope is here that the cost will come down, or at least be limited in the increase side of it, to help make things overall more affordable. A lot of things came up, and there were some questions specifically about Medicare, so I think it's important to know under the health care law, your existing Medicare-covered benefits won't be reduced or taken away. You'll still be able to choose your doctor. They're not talking about, in fact, the hope is that some of the money that is raised in this law, that they'll actually be able to hire additional nurses and general practitioners to be able to do things. They've actually increased the amount of prescription help, particularly in 2010 with their $250 rebate. If you have high prescription drug costs currently that put you in the donut hole, you now get a 50% discount on covered brand name drugs while you're in that donut hole. And between today and 2020, you'll get continuous Medicare coverage for your prescription drugs, and that donut hole will be closed completely by 2020. So there is a little bit of help there as well. You'll also be offered a free annual wellness exam. My understanding is that you'll only be able to get this currently when you enter into Medicare, that you can get a wellness exam. We all know, though, as people age, no matter what your age, there's different medical challenges. So therefore, being able to get a wellness exam, maybe you can be a little more preventative or stop things before they progress from that. So the word free in this case is kind of a nice benefit. So those are some issues with the seniors that I think are important to mention, because, as I said, there's a lot of things out there where people are saying Medicare is going to end. In fact, the idea is it's probably going to be somewhat strengthened. The question is, will it be enough to keep the program going? the next section, and kind of my final before I open it up to questions, is some of the questions I got during registration. And I'll just go through a few of them real quick. And then, as I said, we'll, if it's all right with Jeff, we'll open up for a few questions if there are any. And as I said earlier, you're more than welcome to email me with any questions after listening to this that might be a little more directed to you. The first question is, I have 12 employees. How much is this going to cost me? I also got a, what does it mean for my small business and my 7 part-time employees? So those are kind of very similar questions. The key, they're similar. Number one is both are under 50 employees. So you're not required to provide the health insurance. Now, everyone is going to be affected by the individual mandate in 2014. So if you do not have health insurance, you will be paying an additional fine on your tax return. But as an employer, you are not looking at having to provide them insurance at this point. So someone has 12, 7, the key is under 50, that's not going to impact you directly. How will this affect my retirement cost-wise? Well, the hope is that Medicare premiums will continue to stay somewhat stable. It's predicted, if nothing was done with the Health Care Act, that the premiums that retirees are paying out of their Social Security benefits for Medicare were slated or predicted to have to double just to keep things up current with the way the cost. Obviously, we have an aging population, baby boomers. There's a lot of issues out there in that program. So at this point, if you're currently on Medicare or you will be becoming Medicare eligible in the next few years, that's going to go in, and the rules that you have today, for the most part, are going to be the same under this act. The tax credit will apply. The question is, will tax credit apply to employee premiums only or dependent coverage as well? The tax credits that you get for having to provide or get that insurance as part of the individual mandate, there are going to be tax credits for certain individuals based on their income level. These credits are going to depend on your income level, how many people are in your household, and obviously the cost of the insurance that you got through your exchange. So I am fairly confident that this will approve for both, will come through for both employees and their dependents. In fact, the credits are basically targeted towards 95% of them are targeted towards working families. So the idea is we're going to force you to have insurance. So you're going to go to this exchange. You're going to purchase insurance, and by doing so, you will be eligible for a tax credit that will go towards paying your health insurance. So if your cost is $300 a month for health insurance for your family, that's great. You do your tax return, you actually get a $210 credit for this example. So now your actual cost is only $90 a month. So that's the idea, to provide certain taxpayers a credit to help cover and get them enrolled into an insurance plan through these insurance exchanges. I currently pay $1,800 a month for insurance. Wow. Would it be cheaper to switch to government insurance? That's a huge question, a great question, and all I can tell you is I hope so. I do not know, because we don't have, at least in Washington State, anything yet with these insurance exchanges to tell us what the premiums are going to be based on your family size, income, what the coverage choices are. So that's to be determined. My hope is the theory of if more competition is good, so therefore if there's 5 insurance companies as opposed to 2 that currently offer you insurance, and now you can shop between 5, that there'll be some opportunities there to lower your cost and still hopefully maintain decent coverage. How much is this going to take away from this not rich widow's income? Well, I think there you're looking at the investment income scenario if you're retired, depending on if you're retired or not. And that's going to depend on if your adjusted gross income is over $200,000 for single, $250,000 for married. If you're under that, I don't believe you're going to look at having to pay any additional tax. If you have a year where investment income's high, as we discussed about selling a rental property or something like that, then that could be in the case. But if your income's under that adjusted gross income figure, I don't see there being a big impact tax-wise to you going forward. I think I talked a little bit, what will be the impact on Medicare premiums and access to medical services paid for by Medicare. I found nothing in the research that says you have to change doctors or anything of that nature, and that you're looking at, the hope is that the premiums will not rise any more than they were stated to rise. When I read the statistic that they were stated to basically double within the next 7 years, if nothing was done, the hope is that that increase will be a lot lower. But I'm not holding my breath until we see. Odds are Medicare premiums will have to continue to be increased. The hope is that that will be minimal increases as opposed to what they were looking at having to do and going forward. At this point, there is a question, how will it affect our Medicare PPO, our current health care supplement coverage, and things of that. That's also to be determined. They are hoping that that will continue, but I think that's one of the question marks that time will tell how that goes. We have health insurance that we pay for ourselves. The payment is practically a second mortgage. So will the Obamacare ruling affect our family at all regarding taxes, other than Congress's new ability to tax citizens for a non-activity? So that's a very interesting point going forward. So the idea is if you currently already have insurance, you're not going to have a mandate because you're already insured. So the mandate is geared to those that are currently not insured. So if you have insurance, that is great. Perhaps, though, this may give you a little more competition to shop the insurance you have. I mean, as a financial advisor, I tell people consistently, you need to shop your life insurance. You need to shop your car insurance, your homeowner's policy. Make sure that you're getting quality coverage for a reasonable price. For instance, a lot of people don't realize that mortality tables change in life insurance. You need to occasionally look and see, has anything changed the way they rate their customers that might allow you to get the same or better coverage for the same or less premium dollars. So here is an opportunity. When I've searched for health insurance, I found my options were very limited. So my hope in this is, as a small business owner, is that these exchanges will allow me to hopefully have some competition, and therefore I can match up against insurance company A versus insurance company C and see if I can lower some premiums. So that is the hope that I'm looking for those that already have insurance. Nothing will change. If you already have it, you don't have to worry about the mandate. There's another question about Medicare costs and coverage. So I think I've answered just about everything that is on there. There is a question about having to pay a fine or a tax if you're not, if you're required to purchase health care coverage, and that is true. But in this question, they've been on Medicare already for a year. So if you're on Medicare, it's already under the idea that you're covered for insurance. Therefore, you're not going to have to go out and buy another policy or pay a tax because you weren't covered. The mandate, or for those that are out there today, they have no insurance. They have no insurance from their employer. They are not on any parents' plan. They're not through Medicaid. They have no insurance. And that is the mandate to get those people into the system. It's kind of a carrot-stick approach. They're going to hit you with a stick in the sense that you may pay up to a $200, $300, $400 fine, additional tax added onto your tax return. But there's also a carrot that they're also looking to help subsidize that for some taxpayers by giving tax credits that will go towards paying the insurance. So that's the one it's geared for. But if you're already in a plan with your employer or Medicare, this is not going to have any at least direct impact in the short term for you. So those are the questions, Jeff. I talked a long time, as I tend to do, so I'm happy to try to answer any other questions, and hopefully this was some good information for everyone.
Yeah, David, sounds like a lot of information. It sounds pretty complex. We have opened the phone line, so if you're listening and you have a question for David, you can go ahead, pick up the phone, and just start talking. Anybody out there with a question for David? Going once? Twice? David, I had a question. Did you mention the penalty amounts that are going to come in?
I don't believe I did. Let me find that really quick. Yes. In 2014, because as I said, that's when this requirement to buy coverage under the Affordable Care Act kicks in. The penalty is $95 per adult and $47.50 per child, up to $285 for a family, or 1% of family income, whichever is greater. So it's not a huge penalty, but it is a penalty.
Mm-hmm.
It is something to consider. There may be some people who just say, I'm going to pay the penalty because the cost of insurance is too expensive and perhaps the tax credit is not going to be enough to make a difference. So those are things that people will need to plan for and be educated about to know their individual situation, what they're looking at. But that increase or that penalty, the thing about that I think is most important to realize is in 2015, the penalty goes from $95 per adult to $325 per adult. And in 2016, going forward, the penalty goes from $325 per adult to $695 per adult and $347.50 per child, up to a max of $2,085 per family, or 2.5% of family income, whichever is greater. So it looks to me, when I look at something like this, is they're trying to ease everybody into it. We're not going to hit you too hard in the tax for 2014, $95 per adult, maximum of $285 for a family, or 1%. But just 2 short years later, that max has gone from $285 to $2,085 for a family, or instead of 1% of the family income, it goes to 2.5%, whichever is greater. So 2016, things really start getting expensive if you don't have the health insurance. So hopefully there'll be some options out there that this will pencil. The question is, in Washington State, what will be the options? What will be the options in California, Texas, whatever state you're in, or that you move to or plan to move to? What will your options and choices be?
Gotcha. That makes sense. Well, and again, the lines are open, so if you do have a question, you're more than welcome to go ahead and just start talking, and David can answer that. If there's anybody else. Hi.
Hey, David, this is Maritza. How are you?
Very good. Thanks for joining us.
Yeah, my first time. Just wondering how these things work out.
Yeah.
Hey,
you're doing great.
I am retired. I'm retired military.
Yes.
And with the military, I have my medical bills paid, How does that affect me? I mean, I'm retired and I'm fully covered health-wise with the military.
Then you are considered covered, that you have insurance through your Veterans Health Program. So therefore,
right.
You do not. The mandate does not impact you at all. So therefore, and I didn't mention military, but that's another example of an insurance program. Medicare, Medicaid, Children's Health Insurance Program, Veterans, a plan offered by your employer. Those things are all allowed, that you do not have to go and make any changes. It's only for those that have no insurance that this mandate comes into effect for.
Yeah, because they don't give you per se an insurance card. We just have a retirement card, that we show at any military installation, and we get any kind of service that we need,
Right.
So
it's a great benefit. So that as long as you continue to have that, which you should, you will not have to change for you. But if you have family members or other friends or people that that aren't Medicare eligible yet, that don't have insurance through veterans or their employer, those are the people that this information is going to be important for them to know, particularly by 2014.
But that I don't ever think that I will have 50 employers. All this you're talking is employers, employers that have less than 50 employees. Because I do have employees, but they're, it's like one adult and the other ones are kids. So this kind of thing does not affect me really at all, right?
That is correct. You're absolutely right. You have under 50 employees, so you're not required to provide. Those employees will either have to go and get their own insurance through this insurance exchange program that'll be starting to come into effect next year in 2013. And so at that point, but you as the employer, I think they recognize that for a lot of small businesses that have 1 to 2, 5, 10 employees, it's too much of a burden under the current market out there.
And they're not even full-time, because
That's right.
We don't work 40 hours a week either.
That's correct. So you're good. You're not going to have to do the individual mandate because of your military insurance benefits, and because you're under 50 and employees, you're not going to have to provide coverage if you don't. You can choose to do that, but you're not required to.
No, I just have an insurance for medical, because when I get the people that come if something happens and I have to take them to the hospital because something happens, that's the only insurance that I have with the company. Yeah,
right.
And that is a blessing to have it.
Yes.
Okay, so I just wanted to make sure. Yeah.
Great question. You're welcome.
Dave?
Yeah.
Do you think that an HMO, such as Group Health, to which I belong, is going to have to, because of this law, raise their premium?
At this point, the amount of premium increases, I have not seen anything one way or the other. That is, to me, one of the big questions is how is this going to affect someone that already has the premiums? I just haven't seen that. The hope is that you as an individual will have more choices than you probably currently have, and therefore if they have to compete for your business like just about every other business out there, that perhaps that will help keep the increases down. I think they're really banking on competition, and that typically does help keep prices down and sometimes even drops prices, which of course would be a shock in this area. But I just don't know to what degree this is for sure going to have. To me, it's one of the 2 or 3 things that it's going to be a wait and see. I have a hard time seeing that they won't have to increase it somewhat. My hope is that it will just be less than what they would already be doing.
Okay. I have another question. What happens with people that, like the over 50% that don't pay any taxes? And how are they going to afford this penalty?
Well, a lot of those people will get tax credits. If their income is at a certain level, there's tax credits for them to help pay for the insurance. But they're still going to have to get the insurance. They're still going to have to be because they're going to have to file a return to show that they got the credits. But you're right. There's a large chunk of people out there that, for whatever reason, based on their financial situation, don't pay any taxes. It's kind of mesmerizing that it's as high as it is. But
yes.
They will need to file tax returns and show that they qualify for these, because a lot of people will, otherwise they would get hit with additional tax. And my thinking
I hope the government isn't going to come after those that do pay taxes to pay for the penalty of the people that don't pay taxes.
Well, at this point, there are new taxes, but they're based, so at this point, and that's the thing I've often told people, beware when a new tax comes in and it starts at a high income level. There's no guarantee that 10 years from now they say, we're just not getting enough revenue. We better lower it to people making $100,000 instead of $200,000.
Right.
And then all of a sudden now people are paying this tax rate. Well, what happened? I wasn't paying it for years. So it's a good point that could happen.
Well, thank you. That's all
You're
from
welcome.
me.
Any other questions for David? The lines are open. Well, David, those were great answers. Depending upon how somebody is listening, we're going to have an audio replay of this that'll be posted on your website, on YouTube, maybe on Facebook. If they're listening to this and they're have a question, is there a way for them to get a hold of you? Can you answer simple questions about?
Yeah, I'd be happy to email me or drop me a line. Whatever's easiest. If you have a question, whether you listen to this tonight or a year from now, if you find yourself on the website and you have a question, and whether you're a client or not, I'm happy to just reference that the webinar, and I'm happy to answer those type of questions as best I can. Unfortunately, there is some things that some of these questions challenged me, as far as saying it's going to be interesting to see how the future comes through. I think as time goes on, we maybe do another webinar down the road as we learn more about this and we're actually into those years, and to see how it's impacting people and to make sure they're aware, maybe just on the individual mandates or things like that. So they're more than welcome to send me an email, and I'll be happy to answer a question or have a conversation to do that. No charge. Happy to do it. There's a lot of stuff with this, and the more I talk about, the more I discuss, the better it'll be to help me as well for my clients.
David, what's your email address for the people that are listening?
It's David at PettisRumseyCPA.com. PettisRumsey CPA.com. David at PettisRumseyCPA.com. And our office number is 360-659-8502.
Well, great. Well, as of this recording, there's only 118 days left until the presidential election in November. And I believe, correct me if I'm wrong, but the House of Representatives voted today to repeal the act. And
yes, they did.
So now it probably won't pass in the Senate, but the point being that there's a little bit of time left before the election, depending upon which side of the aisle that you're on. I'm sure there'll be a lot of changes, and you'll keep us up to date on them.
Right. If there's any changes, we'll be happy to do another webinar. And one thing we can pretty much count on, there will be some changes to this law. I think no matter what happens this time, it's just like the Medicare law and any of these other Social Security big things that have happened in the history of this country. They've been tweaked or adjusted through the years. So my job is to keep up on that and report back as necessary if those things happen.
Well, great. David, thank you very much for giving us this information on the call tonight. And for those that are listening, thank you for taking time out. Again, this presentation has been hosted by David Rumsey, CPA of Pettis Rumsey, Inc., and the topic of tonight's call was, how does the Supreme Court ruling on Obamacare affect you? Again, thanks, and we'll hopefully talk to you soon. Thanks, David.
Thank you.